Now it's time to bring in our next guest, Rebecca Walser, president of Walser Wealth Management. Hey there, Rebecca. Thanks for being here.
Hi, thanks for having me, Caroline.
So, Rebecca, I was just talking with Alex about this sort of resiliency that we've been seeing in the market this week. Dow, S&P, both clinging on to positive territory. NASDAQ, as I said, lower right now, but poised to end the week higher. In terms of what's your call on this market, and what do you think the biggest risk to some of the strength that we've seen is?
Yeah, I mean, I hate to take the opposite approach than Alex took, as the glass is half empty. But I would say, Caroline, the problem is we have so much geopolitical risk. We have so much problems at home in supply chains that you talked about in your previous segment about the Internet of Things and all the chips that we need that we don't have. So we have supply chain problems on the food side. We're talking about global food shortages, and we're talking about energy supply problems because of the Russian incursion into Ukraine. So we have so many dynamics that are interconnected, with oil prices spiking. How does that impact the geopolitical risks that are happening with Saudi Arabia not taking President Biden's calls? Things like this are happening. And then you see with oil prices spiking, that is causing the price of fertilizer to more than double. Most fertilizers are petro-based, petro-fertilizers. So, 100 acres, 100 pounds is for 1 acre of corn. So we have corn farmers in the United States that are shifting to soybeans because corn farm is going to be uneconomical this year. Well, then that puts a problem with our corn production, which produces corn meal, which feeds our livestock, which will then have a further impact on our livestock. So the energy crisis, the food crisis, the supply chain crisis with Corona still being a factor. And we know that China maintains a zero COVID policy to this day, shutting down factories this month that will again have a further impact on Apple's supply chain, Volkswagen supply chain, among others. So we have all of these dynamics happening while we have the Federal Reserve telling us that we're starting off with 25 basis, but we're expecting 6 more rate hikes this year. And also they're going to be looking at running off some of their balance sheet. When you combine all of that together, you just don't have anything there that can let me know that this market isn't going to go into a recession and potentially a big pullback.
So on that note, where are you forecasting that this market goes? I mean, if you're thinking recession, are you thinking bear market? Are you thinking 20% declines, or has some of that been priced in with the weakness that we've seen already so far this year?
I think so, Caroline. I mean, I was really talking about November, saying I think this is going to be going into a period of time where we might start looking at taking profits because the market's going to do this gradual come down. So I agree with Alex's point on the earlier session. We do have some things that make us think we might get a little bit of a reprieve here. And the Federal Reserve hasn't taken as shocking as efforts as we were originally expecting, certainly because of Russia's incursion into Ukraine. They've stepped back maybe the initial, force they were going to use. So we start to seem to feel like we're getting a little bit of a reprieve. We don't see oil prices as high as they initially jumped to when Russia and all of these things happened. So we start to think, okay, maybe we're going to be able to manage this. My concern is as we start to see these food shortages materialize and these commodity shortages materialize through the supply chain changes that have been happening since Russia invaded Ukraine, that will then really feel the pain that we just haven't yet quite felt. And that's when we're really going to see this market not like it. So I feel like we're in this reprieve period where things feel like we can sustain them. But unfortunately, if any one thing, Carolyn, goes wrong, if we get China moving into Taiwan, if we get some kind of North Korea missile being test fired again, that hasn't happened in quite a while. We have Iran shooting things into Iraq. We have such a volatile world thing. One thing happens, this market is not going to like it because, as you said, we've seen the resistance as we've come down. So this is the concern, is how strong is the fortress that we're fighting from right now.
So in terms of how you're positioning yourself in this very uncertain, volatile market, are there areas of opportunity? What are you doing with your money?
I think so, Carolyn. I mean, I think the biggest thing is you have to determine your risk tolerance. So we're talking about short-term investors who can do some, sophisticated collared option strategies and make money on the front and the back. We're not talking about those kinds of people. And there's always going to be short-term money makers. So we're not worried about that. What we're really more focused on is the longer-term investor who's maybe already retired, living off of retirement, and really cannot afford to see this market have anything go in its wrong direction. So for those people, we've taken some profits and we've definitely made some gold purchases. We've seen resistance 1920 to 1930. Obviously, 2 weeks ago, we jumped up to 2072, and we've since retrenched, and we're at about 1950, 1960 today in that range. And so gold is a great opportunity. We like silver as well, but it's a little more volatile than we like. So we're really looking at some gold commodities as our short-term hedge for now.
That's right, 1952 right now. We'll leave it there. Rebecca Walser, President, Walser Wealth Management. Thank you so much for your insights. Appreciate it.